I was at a pretty large portfolio level, I thought, relatively at the time. And then this is where it all started hitting walls. There was walls in yields with residential. There was walls with lending. There was also a lot of touch points with the properties I owned. Like I had a lot of tenants, and we were self-managing about nine of them at once as well. And
you got a second job right there, mate.
Yeah, it was just full on, and it started becoming like a hassle to deal with. And now the banks were saying, yeah, we can't lend more in residential, and the yields weren't even worth it. So everything was getting tighter, and I guess this is where we started looking at commercial. And this is where it opened us up to a whole nother level. Like what I found with commercial is there was just a certain scalability that you couldn't get with residential. Like the tenants were larger, the yields were better, the leases were longer. Really attractive to me at the time was the fact that tenants paid all your outgoings. Like,
yeah,
they paid your insurance, your land tax even. Like in some cases, they'll even pay your management fees to manage them. Like it was just a different ball game, and it was about 3 times better from a net perspective.
Welcome to the Get Invested podcast, where we share great conversations with experts from all walks of life to uncover their secret know-how and where they invest their time, their skills and their money, and the benefits that this has created. You see, the truth is that everyone invests. Every minute of every day, we're investing our time, our skills, our energy and our money in something. Some of us are investing consciously, some unconsciously, sometimes for good, sometimes for bad, and sometimes for no impact. Get Invested will help you to start living by design, not by default. I'm going to help you to make it happen, not let it happen. You'll hear the top tips on how you can live with conscious intent so that you can live more, work less, and leave a living legacy by investing now. Listen to the show to discover the top tips on how to get started, make the most of your investment journey, and ultimately to be living your dream, not someone else's. More episodes can be found on iTunes or at bushymartin.com.au/get invested. Thanks for listening, and now let's get invested.
Welcome, freedom fighters. Now, with most normal investment asset values at or near all-time highs, and FOMO, or fear of missing out, running absolutely rampant, where else are you looking to invest? Are you looking to invest beyond your own backyard, beyond your comfort zone, and beyond the limits of your current knowledge and thinking? Well, what if you could invest in an asset with average yields between 7 to 9%, with the potential to be cash flow positive by tens of thousands of dollars a year, and enjoy strong capital growth potential that you can also influence and manufacture? Would you be interested? If so, you're going to absolutely love this week's episode, and you're in for a big surprise. Because the big issue for most potential and existing investors at the moment is where is the best, safe and affordable place to put your money when most asset classes are at best frothy and at worst near the peak of a bubble with the risk of market corrections threatening. We're currently in one of the most rare windows of time when leaving your hard-earned savings in a bank account is seeing you actually lose money to the tune of over 2% a year when inflation's factored in. And with interest rates at their lowest levels on record, and very little likelihood of them rising over the next few years because of the federal government's debt burden being so high and many Australians already having high levels of debt, investors in all shapes and sizes have been flocking their war-chested savings, property equity increases and their access to cheap borrowings to flood share markets, residential property, cryptocurrencies, just to name a few, with massive FOMO-driven demand. The result? Asset values have risen exponentially in recent times, and there's a lot of talk of potential bubbles and bursts. So if leaving your money under the bed is going backwards, stock markets at all-time highs threatening to burst, and residential property values rising across the board, and good properties becoming harder to find and even harder to secure given the rampant competition, where else can you invest? What if there was a little-known asset class that gives you positive cash flow that is double to treble that of residential property and also gives you much longer leases with tenants paying most of the costs, along with the ability to manufacture equity increases and enjoy capital growth? What am I talking about, you ask? Why haven't I heard of this? Come on, Bushy. Don't keep us in suspense. What are you talking about? Well, surprise, surprise, I'm actually talking about commercial property. What? I hear you say. And I can also hear you thinking that you keep seeing in the mainstream media at the moment that commercial properties like office buildings and retail premises are in big trouble with vacancies and other issues given the impact of COVID and the shift to decentralisation and working from home. And with those types of commercial properties, on many occasions you'd be right. But like most things, you need to dig deeper than the surface level scaremongering that the media likes to keep us either greedy or fearful about, so you can sniff out where the real opportunities. Because, like any investment, the devil's in the detail and good opportunities abound if you know what you're looking for. We need to look beyond the media noise and the commonly held myths, to look beyond the boundaries of our own backyards and our often inbuilt prejudices and biases, to test assumptions in order to uncover nuggets of gold that the rest of the stampeding herd are missing and overlooking in their haste and their waste. And the right type of commercial property falls into this category. And it's fair to say that I've actually suffered some of these preconceptions about commercial property myself. As I've detailed in recent episodes with Arjun Paliwal, I've always put commercial property into the cash flow stage of the capital growth to cash flow curve component of our wealth by stealth strategy that I detail in my book, The Freedom Formula. For a long time, I've adhered to the belief that the lowest risk and highest capital growth potential that is both safe and affordable lies in good quality residential homes in tightly held high demand locations with strong and growing income demographics. And for the most part, and over the long term, this still holds to be true. But I've also always seen commercial property as assets that you secure later in your portfolio to achieve superior cash flow, as well as for self-employed business owners to secure their own commercial premises via a self-managed super fund or a SMSF, to take advantage of the significantly reduced tax treatments and the complete waiver of capital gains tax on the sale of commercial assets held in an SMSF post-retirement. But in overheated asset markets where investors and others are falling over themselves to pay ever-increasing prices at the drop of a hat, you need to fish in quieter, less-known locations at deeper depths where the big fish actually lie, away from the fishing fleets that are depleting supply closer to the surface. And this is where good quality commercial property comes in, providing that you charter a commercial fishing boat with an expert skipper who can guide you through unknown waters safely, affordably and easily. Now, this is just another way of saying that you need to invest in your knowledge of commercial property first and learn the language, as well as surround yourself with commercial property experts who can act on your behalf to guide and protect you on the journey to commercial property success. So before we get into it, let's revisit the question of how the coronavirus has affected the commercial market. The truth is that the effect has varied greatly. For example, CBD office space has struggled and will continue to do so. Fewer people will commute to our capital city centres on public transport in order to sit in an air-conditioned office tower where the risk of infection is greater. Retail is also another property type that is going to continue to face hard times. Forced closures have made it difficult for customers to visit their favourite stores, which has led to much more online purchasing. This leads, though, to the opportunity part, because as more people purchase goods online, there's a greater need for logistics and storage. This has meant that warehouses in many areas have been more in demand from tenants and owners alike. Medical properties and other essential service-type businesses have also powered through the COVID-19 environment with greater ease compared with the discretionary spending retail-type businesses. And there are many reasons why each type of business will perform better or worse in continued uncertainty of this post-COVID world that we're living in. But we've always said that property is a long game. So you need to see the bigger picture and understand how businesses work in general before you buy property. So in relation to COVID-19, here's what we're seeing. Interest rates for commercial loans are at all-time lows and they don't look like they're going to rise anytime soon. This means that the net cash flow you receive on your commercial property has never been better. Secondly, due diligence on commercial properties has never been easy to complete. Before COVID, it was much harder to distinguish a strong business from a weak one. This is because a key marker when assessing a property purchase is how a tenant will perform, which is easy to determine now after the pandemic. And this provides a lot of confidence in the business prior to purchase. And lastly, growth. Commercial property is growing in value off the back of falling interest rates and increased buyer demand. There's also a severe shortage of stock. In some areas, stock levels have fallen by as much as 50%, with many owners reluctant to sell their assets while they see no better options out there for making a good return on their money. Increased demand but lower supply is fueling the growth equation. And of course, some sectors are suffering, like, as I've already said, the CBD office market, but others have never seen such great demand. And increased demand over limited supply equals capital growth. I also like the fact that, unlike residential property, in commercial property you have a much greater opportunity to influence and manufacture capital growth because values of commercial properties are largely driven by the rental returns. For example, to estimate the value of a 100 square metre warehouse, which is leased for $40,000 net per annum, the general rule of thumb is to divide the rental by a yield acceptable to the market at the time. So working on a 7.5% yield, the following formula would apply. So $40,000 divided by the 7.5% equals a property value of approximately $530,000. Now, if you're going to negotiate the rent up to $50,000 a year by improving the property or the lease terms or by adding a leasable mezzanine floor to or other improvement, then using the same formula, the market value of the property can be increased quickly using the same 7.5% rental yield up to $660,000, which is a 25% increase in market value. Now, of course, it's not quite as simple as this, but the approach is relevant, and it allows you to manufacture growth if you're smart about buying a property where you can improve the property or enhance the rent and the lease terms. This is particularly exciting, and manufacturing value is much tougher in the residential property world. Now, we touched on commercial property investment with Ben Fitzsimmons way back in episode 44 of Get Invested. So make sure you have a listen to that episode as well if commercial property is of any interest. And today, we take it to an entirely new level with our guest Scott O'Neill, who has achieved amazing things in this space, along with his partner in all things and his wife, Mina. Scott and Mina are the founders and directors of Rethink Investing. They're experienced, sophisticated and active investors who are able to actually retire from their day jobs at the tender age of just 28. Yep, you heard right, 28. So the results are extremely impressive. And they did it by investing in both residential property initially and then evolved into commercial property. With a property portfolio that boasts in the order of 32 properties with a value over $22 million, releasing just under $500,000 a year in passive income, Scott's and Mina's passion, commitment and hard work has paid off in spades. So much so that they were actually able to take a 6-month sabbatical from working life and do nothing but travel Europe on the strength of their property portfolio passive income. Until, strangely enough, they got bored of the good life because it had no purpose or fulfilment, and they decided to teach others how to reach the same property success, which is where their business Rethink Investing was born a few years back. And not just content with their own success, Scott and Mina and the Rethink Investing team have now helped over 1,800 clients purchase in excess of $1 billion in real estate since 2015. Rethink Investing has also been recognised as a BRW Fast 100 company and has become Australia's #1 buyers agency for commercial property investors. Scott's also the host of top-rating podcast Inside Commercial Property, which you can find at www.rethinkinvesting.com.au/podcast. So you can start immersing yourself in the intricacies of all things commercial and learning this new language before you start to invest. Now, Scott and Mina are also the authors of the great book on commercial property investing, Rethink Property Investing, strangely enough. So to whet your appetite, grab yourself a free introductory chapter at www.rethinkinvesting.com.au/book and insert the code BUSHY in brackets alongside your name, along with your email address. Now, the books are very easy to read format, and they demonstrate how anything from corner stores to medical properties to warehouses and a host of other niches in that commercial space can lead to considerable financial success if you do it right. The book's filled with real-life examples and expert advice, and Rethink Property Investing was written to help you earn enough passive income to retire early and enjoy life, very similar to my own book, The Freedom Formula. Now, this invaluable guide demystifies commercial property and shows you how to achieve success using the very same techniques that Scott and Mina used to build their massive cash flow positive portfolio. So whether you're a sophisticated investor or just starting out, now's a great time to create wealth in the long term by adding commercial property to your portfolio. And to whet your appetite even further, before we get into the guts of our very interesting and highly informative discussion today, let me whet your appetite with some of Scott's wisdom in the commercial property arena that I've drawn from their excellent book on the subject that I've already mentioned, Rethink Investing. Let's start with his thoughts on what is actually commercial property. Commercial property is real estate used specifically by investors for purposes intended to generate a profit. And in Australia, it usually takes the form of building within 4 asset classes: office space, retail, industrial, or specialty. However, there are also many other subcategories like medical, hotels, short-term accommodation, etc. So, why choose commercial property? Well, in short, commercial property offers the highest cash flow you'll find in any Australian real estate. In our post-COVID climate in Australia, where interest rates are at an all-time low and high-quality commercial property scarce, this tightening of the market has resulted in yield compression for commercial property, which is effectively capital growth, with returns currently far outweighing what residential property can deliver. Exceptionally high yields, the option to negotiate long leases, with some commercial properties boasting 3, 5 and upwards of 10-year leases, and the opportunity to build annual rental increases into the contract make commercial property an incredibly appealing investment for many. But the most significant reason why you should consider commercial property is the quality of the tenants. Apart from them being responsible for all outgoings, a well-known branded tenant, for example, like Coles or Australia Post, a BWS, an IGA supermarket or a bank branch, they all have their reputations to uphold and will guarantee security and therefore strong returns. Your reward will be a secure long-term investment which produces a high cash flow, and after you've paid your loan in full, with some commercial property being able to be paid off in as little as 10 years' time, all of a sudden you've created a passive income that goes straight into your back pocket. So let's briefly break down the pros and cons of commercial property as I see it. Starting with the pros, when we compare it to residential property, they run a bit like this. Firstly, you can pay your investment off faster and start generating a passive income. As already mentioned, high-quality commercial property has the potential to pay itself off in 10 years, compared to the traditional 30 years a residential property might take. That means that all of that money that is usually going to the bank after the debt's paid is going straight into your cash flow and straight into your pocket. Secondly, you can achieve much higher yields. Commercial property has traditionally offered higher yields compared with their residential counterparts, and with the tightening of the commercial market, along with commercial becoming more mainstream and interest rates at an all-time low, yields in commercial property are being achieved that we just can't access in residential. In this post-COVID climate, yields of between 6 to 9% and upwards are being achieved in commercial properties, compared with half of that in most residential. Thirdly, there's negotiable lease terms. Because contracts with tenants are incredibly fluid, if you know what you're doing, you can use this to your advantage and secure a great deal. Fourthly, the tenant pays all of the outgoings. Unlike residential property, where the landlord often pays for water usage in apartments, council rates or repairs and maintenance to the premises, most commercial tenants sign what are called net leases, which require them to pay all outgoings, or at least most of the time. Number 5 is longer leases. Commercial leases can span anywhere from 3 years, which is usually the minimum, to as long as 15. Number 6, you gain a well-looked after property. Tenants have a vested interest in the property because it's their livelihood, which means that they're more likely to look after it. Number 7, annual rent increases. Most commercial property contracts have annual rent increases built into the leases, which are fixed, often at around 3 to 4% or linked to CPI. And given recent changes in residential tenancy legislation, it's now very difficult to build in rent increases into residential leases. Next is diversification. Holding both commercial and residential properties in your portfolio place you in the best position should either of these markets be going through a downturn. Number 9 is increased depreciation. Commercial investors have the opportunity to claim thousands of dollars in depreciation that are not available to the same extent in residential properties anymore. And lastly, higher quality tenants. As I've already mentioned, you're often dealing with businesses that have a reputation to uphold. This means they're going to look after the property to maintain their branding presence. They'll also pay their rent on time, as it's not a good look to the public if a large company doesn't pay their rent accordingly. Now, to balance this, let's consider the cons of commercial property compared to residential. The first of those is that you need higher deposits. Now, the maximum loan you would usually receive when buying commercial property would be around 60 to 70% of the property purchase price, although there are still a couple of banks that will let you go up to 80%. Now, this compares with 90 to 95% that's available for residential property. This is because commercial property is deemed by the lenders as being more risky, and their loan-to-valuation ratio, or LVR, is therefore lower. Residential property can be purchased with as little as $50,000 as a deposit to cover all necessary costs. Commercial, on the other hand, to get into a $600,000 property, is more like a $200,000 minimum. So unless you've got a big savings war chest, you may be better to start in residential property, and once you've grown that available equity, then you have the deposit to leverage into commercial. Secondly, it has complicated lease terms. When you purchase a commercial property, unlike residential, you're entering into an agreement with the tenant and their business. Every term can be up for negotiation, and you'll need a seasoned lawyer and a negotiator in your corner to make sure you understand exactly what you're signing up for. Thirdly, they're more sensitive to economic conditions. Commercial property is directly linked to what's happening in the economy. For instance, as we've already discussed during COVID, there's been a decline in demand for certain office assets and some retail assets. This has been due to people working from home and also shopping more online. However, where demand for these assets has fallen, others have fared incredibly well. As I've also mentioned, industrial assets such as warehouses have flourished, with growing demand for online companies needing storage to park their goods. At the same time, smaller offices, coffee shops and local retail supermarkets in suburban areas have done incredibly well as people are staying closer to home. Next is the con associated with the reduced potential for capital growth. Now, capital growth is tied to a few different variables here. Business confidence, the strength of the lease, and the state of the economy are just a few examples. Fifth is the potential for longer vacancies. Now, signing a commercial lease is a huge financial commitment for most tenants, and this, coupled with commercial property having increased exposure to economic cycles and managing the end of a lease, where you may be required to make repairs or undertake maintenance, all mean that you need to be prepared for longer vacancies. Number 6 is that commercial properties are potentially harder to sell. This is because commercial property is traditionally seen as riskier, and it requires a deeper understanding of economics and business compared with residential. The best time to sell a commercial property is at the beginning of a lease with a tenant who's doing very well. So, while there are certainly differences between residential and commercial property investment, the pros outweigh the cons in the context of adding high cash flow assets into your portfolio mix, especially in the latter stages when you build up significant accessible equity in your residential portfolio like Scott and Mina did. And Scott and I are also of the same belief that investing now is one of the greatest opportunities that we're ever going to see. With Scott's commercial properties, they're seeing net yields of 7% plus, with commercial lending rates under 3%. Now that's a massive 4% gap, because historically you normally see a gap of only 2%. This means that right now there's the opportunity of a lifetime to get the best cash flow returns ever in commercial property. This, in turn, should result in strong capital growth as the gap between these two metrics starts to narrow. So, given all of this, Scott's message is really simple. Don't think of commercial property as a risky investment just because we're in a pandemic. Scott's team target the most resilient types of businesses. And as you'll hear during our great chat today, Scott's strategy of buying medical, logistics and other essential service type investments with strong tenants has proven to be very resilient. Now, in recognition of their outstanding achievements in both residential and commercial property investment, in 2019, Your Investment Property awarded Scott the Strategic Property Investor of the Year. So today, we're going to traverse the full ins and outs of Scott and Mina's full journey through residential to commercial property, and we pick up some absolute gems, learnings, tips and tricks for you along the way, where we do deep dive discussions on the impacts of a forever deadline, the leverage benefit of property over shares, how rent vesting was critical to establishing their property portfolio, how to avoid red line stress when investing, how to transition from residential to commercial property. Scott dispels the common myths that are held around a commercial. We talk about how you can access syndicates to secure commercial property. Scott outlines the benefits of a 2-speed portfolio. He also talks about their transition to retirement strategy, which is really worth listening to. He gives you a great run around the country on which areas he thinks are best to invest in at the moment, so make sure you listen out for that. And he highlights why now is actually a good time to get rid of any dud properties by selling them for those properties if they're holding you back. So keep an ear out for that as well. Now, the only challenge that I can see that Scott and Mina currently have is that they currently manage their entire portfolio themselves. So this has created more than a full-time job managing them. And as you'll hear me suggest during our discussion, at some point they may need to consider getting an independent property manager and or asset manager to free up their time. Because as you know, in my view, you're not truly wealthy until you have time on your hands to do what you like, when you like, how you like. Now, creating a full-time job when you invest just not my idea of lifestyle freedom. For me, it's about being the owner and manager of your independent property team, where your only role for a few hours a month is to manage your managers. But I digress here, because in every other aspect, Scott and Mina O'Neill have demonstrated that commercial property has turbocharged and fast-forwarded their journey to financial independence. And much of Scott and Mina's success is owed to the fact that they've always looked beyond their own backyard, beyond their familiar territory in Sydney, and even beyond the traditional investment focus of residential property to commercial property. They like to do things differently. They like to challenge the status quo. They like to take calculated risks, and they soon realised that you can invest more successfully outside of where you live. By looking beyond your own backyard, you can look to different asset classes to get you there, and discover that the local residential market is not the only way. Their fast-track success has come from their transition to invest in the commercial property market as well as the residential property market. It has held the key to their future wealth and underpinned why they set up their Rethink Investing business. As a result, they're part of a new generation of investors. They invest very differently from their parents and most others, finding a different path from the one they followed to create their wealth. They've chosen to focus on higher cash flow investments rather than the outdated negative gearing model. Why? Because it works. There's no doubt that today's conversation is going to inspire you to go to the next level in your property investment. So, no matter where you're at, I'd love to invite you to join me personally on our unique Know-How Property Freedom Flight program, where I'll personally guide you through my proven process for property investment success. To book your ticket or to find out more, just jump on knowhowproperty.com.au/freedom fighters, or just click the link in the show notes. And if you want to hear more about Scott and some of his tips, along with all of Australia's leading property investors and independent professionals, join me and the other 120,000 plus regular listeners every week as I now anchor the country's most popular and longest running property show, Realty Talk, for Kevin Turner. So I look forward to seeing you on channels.realty.com.au/Realty Talk, where we share short and sharp take-home tips and tricks on all things property. Now it's time for you to start looking beyond your backyard and your investment comfort zone by enjoying this extremely informative and awesome chat with Scott O'Neill. Welcome, Freedom Fighters. Now, it's fair to say that COVID has changed the face of many businesses, and we've seen entire companies that are now working from home, retail shops that have switched to online selling, and many cafes and restaurants have simply shut up shop. And as a result, it's fair to say that commercial property has taken an absolute bollocksing from the mainstream media in recent times. So it begs the question, is investing in commercial property still a good idea? Well, like most things, not all commercial properties are the same. And just because CBD office buildings and retail shopping might be doing it a bit tough in certain areas, this doesn't mean that this applies to other types of commercial properties. So to do a deep dive on all things commercial, and to open your ears to the opportunity that the right type of commercial property offers, we're joined by highly acclaimed commercial property expert and active investor, Scott O'Neill. So welcome, and let's get invested, Scott.
Thanks for having me, Bushy.
Mate, been looking forward to this chat for a while. You've been, very visible in the commercial space for quite some time now. But for those listeners who haven't heard of you before, can you start by giving us a rundown on who you are, what you do, and most importantly, why you do what you do, mate?
Yeah, sure. So Scott O'Neill, I run a company called Rethink Investing. So we're actually a specialist commercial buyers agency. So we're full-time commercial investors, and we started the company in 2014. So we've been around for a little while, and relative to this new industry at least. And we're literally just finding properties representing the buyers all day, every day. And so we target things like industrial assets, retail properties, medical assets, all these types of things. And how I got into this business, so it was almost a bit of luck, really. Like, I was an engineer prior to this and started investing, did pretty well out of it on a personal level. And, but I heard some people needed help and they started asking for help, and out of nowhere just started helping people invest in the same properties I was buying at the time. And fast forward, many years, we've helped over it's up to 2,200 clients roughly, about 1.25 billion in property. So it's sort of, I didn't even know what a buyer's agency was back then. And now it's sort of, here we are. And it's, been a really interesting few years, to be honest.
Yeah, brilliant, mate. Well, you've certainly done, having done my homework, you've personally done very well out of property, and I'd like to unpack some of that so that the listeners really appreciate the success that you've personally had and how that then puts you in such a great position to help others to do the same. So let's wind it back if we can, and I'd like to sort of dig in a little bit of detail to take us right back to the point when you decided that the point where you decided that you would start to invest in things other than work. Can you take us back to what was happening at the time and what led you to that decision?
Yeah, so I came out of uni with an engineering degree, and really, I guess I sort of chose engineering because I like the idea of sort of being outside and not just being stuck behind a desk. It was more construction side and a bit of desk work, and that variety sounded quite exciting at the time. But when I started the career, it just didn't really match what I thought it was going to be. It was quite granular, a lot of the work, and huge hours, especially when you're chasing, forever deadlines. And that's sort of what most project managers or, anyone involved in construction would know that also well. It's a forever deadline. That's and there's always, you're just pushing stuff uphill all the time. And and I just thought, maybe that's not what I want to do for the next 40 years. And I was following the career path. I moved into the building material industry. So sort of, companies like, they were called Wholesome at the time. That was the old ready mix stuff. So there's all mines and concrete plants involved in that. And I like that a bit better because it was a bit more business orientated. So I didn't even know I liked business at the time, but just sort of managing a company's P&L, even a small portion of that company. It was good fun, but I've just found the career path quite restrictive, especially for myself. I progressed quite quickly in these companies, and I was sort of 26, managing about 130 or 40 people from memory, across mines and logistics businesses and stuff. And then I hit a ceiling, and they told me I needed to get an MBA to progress to the next job. And that was, and then, halfway through that degree, it made it pretty clear that they didn't really want anyone under about 45 in that next level role. So that was nearly 20 years at the time. And I thought, I'm literally going to be stuck doing this same exact role for 26 years if they follow that trajectory. So it just made me just put all my energy outside of work, or, even a little bit in work, to make property investing a serious thing. And I bought my first property at 23, just a little house in Granny Flat in Sutherland in Sydney.
Can we just before we start to really drill down on that, why decide to invest, and then why property?
So investing was a way of somehow bringing retirement forward, and it didn't need to be instant. Like, I was quite conservative how I used to think. I thought, if I brought retirement 5 years earlier, that's a big win. Or even 10 years, that's a huge win. So that was why I thought, well, how do I make more money than my job's going to pay me? And it was like creating another little side business, and property was a good way of doing that passively and leveraging what little money I had at the time. And, it allows you to control a larger asset base. And obviously, the younger you are, the more time you've got left in the market to have the compounding effects work for you. And that was why I was just hooked with property. I had goes at shares, and had some wins, had some losses, but just the non-leveraging factor of shares meant no matter what I did in it, it was never going to be that impactful with the dollars I had. And property, it just felt like I was just doing a lot more with it. And I never looked back. Property was my full-time investing method, and it's pretty much how it is today.
Yeah, well, let's really sort of unpack that journey then. So you decided on property, and were there any books you read or anything that sort of really excited you and inspired you to go, right, this is it, that property is going to be the vehicle?
It was probably that Rich Dad Poor Dad one that everyone read at the time. It was such a simple book, but it really just showed the difference of only working for a salary versus creating passive income. You know, the book was not written for Australian real estate. It was really the theory of it, and it was such basic but very understandable theory that really hit home. Like it's going to be hard to get ahead if you don't try something on the side. If you rely on your job only, you can do well. You can chase the career ladder and get paid very good, but even if you're doing well, it's good to do things on the side. You're just going to amplify the results, and that's what that book really, I guess, made me think from an early age. And it was probably those old property magazines when there was 2 or 3 of them in circulation. No, I used to get all 3 of them every month, and just reading investor stories was really inspiring for me at the time. You got to see, I remember reading about some farmer that, at the time he built about a $10 million portfolio, and this was, 10, 12 years ago. And it was great. I thought, look, good on him. He did that, and he set his family up because of it.
Yeah, brilliant. Okay, so you got all excited. What was the next step? You started delving into property. What did you decide to do, and why? I remember I was about 17, and I was working part-time jobs, and as naive as I went to a mate with the bank and said, look, we've got, I don't know, I think it was like 15 grand total at the time. And I thought, how can we get a bank loan? And because we heard one of our tradie mates who had started working, he's a couple of years older than us, and he was 19 and he had about 3 properties because he started working really young and did well. And we were in uni just working bar jobs, and it was we wanted to do what he was doing. And the bank quickly said, you don't have enough deposit, your job's a part-time, there's nothing going for you, basically. So we got politely showed out the door. But the lesson was, it was just, get a good full-time job, and we couldn't do that until we finished uni. So we parked that idea up and didn't really do too much with it. But it was just a good lesson, like, to show at least we knew what we had to do, and we were restricted because we were studying and forced to do that half the time with our. But as soon as I got a job as an engineer, it was just a matter of saving a bit more of a deposit, and we were ready to go. Like, we were preempting it, to be honest. It was ready. It was just a matter of just trying to make the bank work with us. Yeah. Okay. So how old were you when you bought your first?
23. So looked for about 12 months to buy the first property too. So I nearly went down the owner-occupier route, which I'm so thankful I didn't at the time. I was down in the Sutherland Shire. We were looking at 2-bedroom units in Miranda from memory. They were about $400K at the time.
Yeah.
And then, I just saw this house a little bit further out in Sutherland, and it was $480, but it was a 5-bedroom house on 600 plus square meters of land. And it clicked. I went, why would I want a unit that's going to pay strata for the rest of my life? And let's be honest, a 2-bedroom unit, if I was ever to have a family, I'll probably grow out of that quicker. So it's not a forever home. It was just got lucky, went with the house, and that was one of those moments. If we went to the unit, it would have made, in today's terms, probably $1 million difference in wealth.
Exactly. Massive. So you were almost an accidental rent investor as a consequence, or it was like, no, I can see the merit in continuing to rent, but put more horsepower into a higher asset with much stronger potential.
Yeah. So, and look, the only reason, you're right. Like, I was always comfortable with rent investing, and I was lucky enough to have a partner that was too, because I know I've got a lot of clients, and one of the partners is always more keen on a house than the other. And if you don't have the same goals, that always makes life harder too. If you want to build a self-sustaining portfolio, you almost need to go all in this market and really focus on it. If you go load up on a multiple $1 million Sydney house or Melbourne house or Brisbane, now is your first property, that's probably you done. You're going to have to just pay that off, and that's
and yet you haven't got the taxman or the tenant helping you either, so you're pretty much locking away your potential to do anything else for at least 20 years.
Exactly.
Well, that's a pretty smart observation early on, and few people are smart enough to make that decision, because we've sort of been brought up to believe that you've got to own your own home first, and then start considering something after you've paid off the home loan in many cases, unfortunately. But so you bought that property in Sutherland. I'm assuming that went fairly well. Where did they get you to, and what was the next step from there?
So 2010 was the year that all happened, and you may remember that was a pretty rubbish year for property.
Sure,
it actually declined for a bit, and I remember reading all those forums, like typical forums where you're just getting all these people that are, saying the world's falling over, and I was scared, shitless at the time, that I was buying a house for 480 and it was going to be worth 300 pretty quickly. But what saved me was the fact that it had 2 rentals on it. So I was actually renting for $660 a week. Nice. So there was it was just a classic dual income, and it was positively geared with the debt, about sort of $200 a week, $250 a week clear.
Nice.
So that just meant I wasn't really fearful of the I guess dropping in value, because time would heal that. I wouldn't sell at a low point, and I figured if a recession hit, a really bad one, there'd be more renters trying to go for those cheaper rentals anyway. I guess that's what I thought when I was at that age. And
makes sense.
And but look, to answer your question, not much really happened for 2 years. We didn't buy again until 2012, and we bought a unit in Maroubra. That was really just a life. That was kind of an owner-occupied purchase, but.
Okay.
We bought it because at the time it was still cheaper to purchase than rent in that location, eastern suburb of Sydney, and we basically made the call to do that. It was we were getting married or not far off getting engaged, at the time. So it was sort of that we did go down that route reluctantly. We bought the house, but it was really just because we couldn't find another property in Sydney that produced the same results with cash flow as the first one. So that was in a way potentially one of my mistakes. I didn't look beyond our own backyard. We were too fixated on just only buying where we lived. And look, that property we bought for about 620 odd thousand. And then, we didn't buy again for about a year and a half after that. But this is when Sydney started ramping up in value at this time.
How leveraged were you into those first 2 properties? So what was the level of borrowings on the first one and the second one?
First one was 90%. Second one, we went to ANZ and they did an 85% lend over both of them. So
they crossed them, did they?
No, it's 2 separate 85% loans. So it was just a product they had at the time, which made life easier from a lending point of view. So we're really just going off our savings at the time, and hence why my wife and I worked for about 6 years to save the deposit for that first house, and that was pretty much part-time jobs, and and then we got our full-time jobs out of uni. So we scrounged up about 60K to get that Sutherland property. So there was a stamp duty concession at the time as well, which was helpful.
Yeah.
And then we basically saved again over a couple of years. Our incomes were going up a bit as our jobs got a little bit better, and then the rest was I then moved to Port Macquarie after that, and this was our third purchase, which was 4 units on one title.
So that was you were chasing career to go to Port Macquarie, or what led you to go there?
So it was career, exactly. So I had 2 job offers at the time. One was with One Steel in Perth, and the other was in a company called Adelaide Brighton.
I know them very well. Yeah, because
I'm an
Adelaidean.
Like a flip of a coin. Yeah, it was a great company to work for. It's I really enjoyed working for them, and we picked that job because it was a bit closer to home. My wife's mother had terminal cancer at the time as well, so it was a bit of a bad time personal wise, and then moving from home and driving back and forward from Port Macquarie every weekend, literally. It was a lot of time on the road, but I guess it was a means to an end, and my wife was very supportive of that. She left her job to come up into Port Macquarie, and we did it because we knew it would speed up retirement. Like, it was a well-paying job for my age, and it allowed us to then pretty much accelerate what we were doing with the properties, and that's pretty much where things started happening a lot quicker for us.
Okay. So you mentioned that units next. Why units? I'm just keen to unpack your thinking around the time as to why you went down that route, and so the listeners can sort of gain the learnings from that.
So for me, it's all about building a passive income. There was 100. As I said before, our first property was about 200, 250 a week clear in our pocket. So that 10,000, or it was about 15,000 at the time, was quite attractive. I thought that pays for a holiday. I can literally go to Europe for a couple of weeks, and that property paid for that. So it was nice as a secondary income. And then I always wanted to replicate that, and we then stumbled on this one in Port Macquarie. It was renting for about $810 a week, and it was $425,000.
Wow!
So huge income. It was over 10%, and it was a strange property. Like, there was 4 units. Like, there was 1 3-bedroom, a couple of 2 bedrooms, and a 1 bedroom. So it all totaled up to $810, and it was another sort of 20,000 plus income we created. So bought that, and then when we found the properties in Sydney were growing, and I guess we wanted to buy another unit block. So I literally spent every night Googling unit blocks, and just wanted another one of these, because what if we could create another 25 grand income? All of a sudden we're up to about 60 at the time, because there were rental increases happening back in Sutherland, and we were now renting our Maroubra unit as well. So everywhere we looked, the rent was growing, and it was starting to be like a proper little side business. And now that we had sort of better paying jobs, we could feed more into it quicker. And it became very addictive. It was just, how do we speed this up? And we looked at ways of strata titling units, and this is how we created a lot of equity to build our large portfolio. It was not just about cash flow. It was, how do we get cash flow and equity, and also buying a growth corridor, or somewhere where there's upside in capital growth. And we, it was just replicating that again and again. And we bought 3 units on one title in Gold Coast. We actually bought 2 unit blocks in the Gold Coast, and they were, again, 10% yielders at the time.
Oh, so again, reason for focusing on the Gold Coast as the location? What drew you there?
It was almost as simple as we just couldn't find them in New South Wales. Where was the next most comfortable place? Gold Coast. So it was very, very basic. And I actually spent a summer up in the Gold Coast too when I was in uni, and I lived in Broadbeach, and it was, I knew all the areas because we were working up there as well at the time. And it just made sense to go there because we were familiar. So and it was really good numbers on the properties, and knew the suburb, and away we went.
So that, again, what, 1 in 4 or 1 in 3 did you say in the Gold Coast? What did you pick up there?
So we bought 2 3-unit blocks. So 2 of them, and both had 3 units on the one title, and then we split one of them and just we couldn't really split the other one because there were firewall issues and stuff like that on the other, so we just left it as a cash flow.
Yeah, just while we're drilling in on that, for those listeners who haven't been exposed to this, the key here with strata titling is that immediately you can do that, you effectively increase the value of that property significantly because you can effectively sell it as a standalone. Do you want to add a little bit more to that? Because I'm very keen to educate the listeners on the benefit of doing that. So just talk us through that a little bit if you can.
So the real basic analogy for that is, think about a cake. You buy it as you're getting it for wholesale price. It's more difficult to finance as well. So as a property that had, difficulty getting finance, let's say you got 5 units on one title, there's less buyers for that compared to the individual unit. So if you can chop it up, you can actually value it at a higher square metre rate because it's more accessible to more buyers, and they're happy to pay a slight premium for it because it's in their range. So you can chop up the cake and sell the slices for a premium. And that's what we were doing, but we weren't selling it. We were revaluing it. And that was freeing up, normally about 20% equity at the time.
Nice.
And I guess one point of disclosure, I still look for these type of opportunities today, but I don't think I haven't seen one work for about 4 or 5 years now. They dried up because what happened in those sort of 2014, 15 periods, I noticed there was a lot of people with super funds now buying them.
Yeah.
And they pushed the prices up very quickly. So you actually didn't even need to strata title them at one point because those 10% yields that were once on offer were now being sold at 6% yield. So there was, massive yield compression in the unit blocks, similar to what we're seeing in commercial now, which we can go into later. But the opportunity of the unit blocks were great back then, and that's why I was obsessed with them. Like we bought a second one in Port Macquarie that was 5 units on one title, and it was just like every time we bought, the numbers were working very well, and that's why we stuck to it. And then it's sort of by the end of 2015 that I never saw one worth buying again because the yields compressed.
Yep, great. So if we just sort of total up by that stage, when you get to that point, what's the value of the portfolio and the amount of debt that you've got against it? Just so I've got a sense of what the free equity position is. Do you know roughly?
Yeah. So look, without perfectly time stamping it, it was sort of around sort of 18, 19 properties at the time. So we bought a few houses in Brisbane and with the strata title, that turned 1 into 3 properties a couple of times. So at about sort of 18, 19. Value was around 10 or 11. And we were running at about, at the time, 65% debt. And that was around sort of the age of 26, 27. So
that's pretty low LVR given the size of the portfolio. Were you relying on equity growth in existing properties to then access that to fund the deposits on the next? Is that you were using that capital growth and accessing it to keep growing the portfolio? Is that how you know to do that so quickly?
Yes, but we were only doing equity releases one at a time. So you could have met, like, let's say our first house in Sutherland, which all of a sudden we hadn't revalued for a number of years. That would have been sitting at very low LVRs because the equity build up. So we didn't just go revalue every property because it wasn't. Yeah. It wasn't about just trying to go red line. And there was some properties where we had to red line to get it over the line. Like, it was to the last $5,000 buffer and things like that. And and that was stressful every time we did that. And every time I did that, I almost regretted it, to be honest, because it wasn't worth the stress. But there was a couple of examples where the redlining really paid off as well. Just by getting into an asset that I otherwise wouldn't have. And
talk to us about that. Can you give us an example where it's like, oh, this is pretty tight, but the opportunity is too good to miss? Talk us through what it was and what your thinking was at the time.
So the second unit block we bought in Port Macquarie, this was we paid $710,000 for it. This is 5 units right in the middle of town. So nowadays, like, I haven't even checked, but units are probably $350 minimum in there, and there's 5 of them. So it's gone up. It's probably worth over $2 million, and that was 5 years ago. So I'm very thankful we redlined to get it, but the bank was causing us problems because it was not a standard loan. This was 5 units on one title, and it was the first 5 unit block I ever bought. All the rest were 4 or less on one title. Yeah. And basically the bank wouldn't lend us enough, and I was short. I was short about $50,000, and I had to get this horrible personal loan from NAB at the time, it was like a 16% interest rate, where we drew it out, and I was literally just pulled all of it out at once to fund the deposit on it through another bank. It was just playing around with all this bank's money that, I didn't really have at the time. So I just ran the numbers and said, yeah, it would take us about 4 months to get back into the black.
Yeah.
If everything went right, and if all the rent came in and all that kind of stuff. So there were no major hiccups, but it wasn't fun living like that for that period. And if something went wrong, maybe things could have been worse. But look, it did pay off, because like I said, that property is now worth, a lot more than what we paid, and that helped us leapfrog into other assets at the time. But it's just, I think if you can just plan a bit better finance-wise, which that was what I was just impatient, because I knew this stuff was working, and I just saw the property and I knew I had to make it work. It wasn't a matter of plan the finance and then buy the property, and that's probably what I should have done, because you could have lost the deposit in the mix of all this.
Totally. It's something that we do a lot with our clients. Let's build it on paper first and then go and find the property, not the other way around, because once you become emotionally attached, once you've found this great opportunity, it's like, I can't let this slide, and then it's like, how am I going to make it work? And then if you're sort of staring at the ceiling for nights, for months on end, because you're that close to the line, then that isn't a lot of fun.
No, so, and that's a good. I remember staring at the ceiling. Literally, it was like, things had to go right every day to sort of make, and a lot of people do that, and I just think in this lending market now, it's slower and there's less. I guess things are tougher now that APRA's sort of been through the mix. So you got to be careful doing what effectively I was doing back then, and but you can still do it. It's just a matter of probably planning a bit more thoroughly than I was. I knew the property side of things. I just wasn't perfectly suited with the finance side yet.
Yeah. Good learning, Zai, because it's there's a lot of my memory bells going off as you're talking through this, because I was exactly the same. I focused very heavily on the property side, and then sort of shoehorned to get the finance to work, and then suddenly realised, hold on, this is a game of finance. If I don't have my finance in order, then I'm not going to be able to secure the asset base that I need. So a pretty important lesson to learn early on. No, that's awesome, mate. So we've got to up to where were we? We've got about 19 properties, and the portfolio at the time was around the sort of 10, 11 mark. The unit properties weren't working. The numbers weren't stacking up. Where did that lead you to in your thinking, and what did you do next?
Yeah, so this is where, to get, I was at a pretty large portfolio level, I thought, relatively at the time, and then this is where it all started hitting walls. There was walls in yields with residential. There was walls with lending. There was also a lot of touch points with the properties I owned. I had a lot of tenants, and we were self-managing about nine of them at once as well. And
you got a second job right there, mate.
Yeah, it was just full on, and it started becoming like a hassle to deal with. And now the banks were saying, we can't lend more in residential, and the yields weren't even worth it, to be honest, because remember I said those unit blocks were compressing in yields. So there was no house and granny flats worth buying that I could see that were in decent areas. So everything was getting tighter, and I guess this is where we started looking at commercial, and this is where it opened us up to a whole nother level. Like, what I found with commercial is there was just a certain scalability that you couldn't get with residential. Like, the tenants were larger, the yields were better, the leases were longer. Really attractive to me at the time was the fact that tenants paid all your outgoings. They paid your insurance, your land tax even. Like, in some cases, they'll even pay your management fees to manage them. Like, it was just a different ball game. And I didn't really know the full extent. I was just attracted by the yields at the time. Once I was, completely through realestate.com.au or Domain, there was nothing left to look at. So you go, all right, let's look at what's commercial got on offer, and just started plugging numbers in spreadsheets, and it was about 3 times better from a net perspective, and that was without even getting deep into it. And I thought, well, this has legs. So now I've got to understand it. And I remember I didn't make any moves for about 18 months in it. I was just looking, putting a bunch of offers in, things getting rejected, thinking I wanted to buy a property, but then I found problems with it. So there was no good literature on it. There was it was like a big dark world with no info on it. And that was the tricky bit. There's plenty on Resi. There's plenty of books out there on Resi. There's plenty of, daily news stories on residential, but commercial, it's out of sight, out of mind, but it was generally a place where fund managers were just buying big properties and then there's just a few people in the know buying the smaller stuff and I wasn't one of them at the time.
So how did you educate yourself? Because that would have been quite challenging, I would imagine, at the time.
Yeah, it was just time. Like that's what I said. It was about 18 months of just mucking around and talking to agents and just trying to sort of work out what I was comfortable with. And I finally found one that I was comfortable with. And it was like a little mini supermarket. This was in Perth at the time. And the business had been operating for 20 years. Perth was doing terribly at that time too. So I liked that. I thought it was counter-cyclical. Or if this business can survive that market and they've been through the last 20 years, then that should be good. And then it actually, I bought, there was 2 titles, 2 leases. So the other one was like a fish and chip shop. He'd been there for 30 years. So it was just the fact that we'd been in business for so long, and the yield was, up over 8% net as well. And,
nice.
And just went it. I bought the property, and this was after looking at many others. And the big light bulb moment was one of the leases. So the lease was 9 months left on the supermarket to run out, and that was a risk. The bank didn't like it either. They gave me a higher interest rate because of that shorter lease, but they were happy on the other lease.
Yep.
Valuation came in fine, but when we got the lease renewed on a new 5x5 year lease, the valuation went up. It went up over 10% at the time, and so it just created 10% with a stroke of a pen. And that was something I've never experienced with residential. There was always manual work you had to do, even with a strata title, which is quite non-intrusive on the property. There's still a lot of work to do. All we did was change the lease on the property, and the bank loved it and created equity because of it. So let's just unpack that for a minute, because this is a really important differentiator between resi and commercial, and something that I really want the audience to get their head around, because in really simple terms, the way the banks in particular and others look at commercial property is they'll look at and jump in here to expand on this, please, because this is your core expertise, Scott. But my understanding is that they'll look at the annual rent, they'll divide it by the yield, and that'll give you a rough indication of what the current value is in those terms. So using that formula merely by extending the lease, so one gives the banks more comfort because that's less risk to them, and potentially increasing the rental amount, you've automatically created that extra 10% value that you've just spoken about. Yeah, exactly. So commercial's all about lease value, like how to value it, lease value. So that could be as simple as just exactly how much net rent you collect. The other way to improve the value is to increase the security on it, because remember, the longer the lease, the more attractive it is to more investors. Like if I show you a warehouse with a 1-year lease on it versus one with a 10-year lease on it, you're going to pay more for the 10-year lease, because a lease is a legal requirement to pay rent. So it's not like residential where the tenants can pretty much bail on you and there's nothing you can do with it. Like you can go to the tribunal, but you've got no chance. It's tenant friendly. But with commercial, a lease is the lease is the lease. Like the only way to get out of that is to sublease the property. But like if they just can't run away from a lease, because you can go through a litigation process, sue them, and put a black mark on their credit. Like it's a messy process for the tenant. They would not want to do that. So leases are actually a value uplift. If you've locked in future revenue, the bank or the valuers will actually value that into the equation. So that's all we did. We increased the the weighted average lease expiry, WALE, that's just an acronym in commercial.
Yeah.
The WALE went from 9 months to 5 years. So that increased the value because the security was better.
Yeah.
And that meant more people would like it. So the valuer would increase the value on it.
Yeah, of course. Yeah, brilliant. So that's great. So secured that first one in Perth, and I'm probably guessing that was sight unseen, given you were in the eastern states.
Yep. So we were actually on holidays in, I think, we were in Japan at the time as well. So we were sort of doing all these little print-offs in a lobby at 2 a.m, just trying to get it in time because I wanted it, and I just saw it as an income producer, and it was producing after all costs. I'm sort of just trying to remember. It was producing about sort of 80,000 gross on it minus the costs, and by the time it all washed out, it was about 35-40 grand income again on top of it. So
nice.
It was just every time we were buying it was like another 20, 30, 40, and it was really helping, and just took the pressure off work. And that's after that, that's where we stepped away from work. We had about 150,000 passive income at the time. We stepped away for two reasons. Like my wife's mother actually passed away that year, and we're living in Port Macquarie, and we're doing that drive back, and it was just a whole, life's too short moment type of thing.
Yeah.
And we just pulled the pin on work and then just went to Europe for 6 months after that.
Yeah, okay. Well, and again, I'm getting granular, but I think this is really important for the audience to get their head around. Normally with commercial, you've got to stump up a much bigger deposit. So, LVR is 60 to 70%. I'm assuming that without knowing how much you borrowed against that property in Perth, that you probably need to kick in equity potentially from the residential properties at that stage to make that happen. Is that how you brought that together?
Yeah, so we were always sort of buying at the time. It would always be like one was an equity purchase, the next was savings, and then back to equity. So it was basically in that kind of line. But what we were doing over time was reducing our overall LVR. Like from a lending point of view, you can't get say 12, 15 million in commercial property at an 80% loan. It just won't happen. So we found like we were restricted by banks a lot. So going in with 30% deposits and higher cash flow properties was a way of just keeping the leverage quite healthy, and the rents were more than covering all the interest 2 times over type of thing. So it was it meant that we could have the conversation with the bank, and as long as we were planning the residential side of things well, it did help us keep going essentially. So the commercials were always 70% loans. So we generally had to have the 30% cash or refinance cash sitting in an offset account that we then contributed to the next property. It was always about just trying to get that deposit available, and that was almost the goal. And then once we did, we'd then buy. Got
it. Awesome. So you picked up the one in Perth. Did you add to the commercial side of the portfolio from there?
Yeah, bought a warehouse in Newcastle. That was just a sort of about 410,000 from memory, 7% yield, 3-by-3 year lease, and that was a great little addition because it was it was just 4 walls, a real simple build, just good area in Mayfield in Newcastle, and it was prices were growing too. We saw very rapid growth in that market. We didn't do anything to that. We just kept renting it to the same tenant, and we found the equity grew about 15% in 12 months because yields were compressing in that area. Like 7% was very tight for that market, and we did buy well, I felt, at the start, which kind of helped us get a bit of that shoot off in the growth. And then basically, we bought. What else did we buy? We bought. Bought a warehouse in Rockhampton. That was like a Dulux store. We bought some retail shops in Brisbane, sort of 3 in a row that had development upside. We bought. What else did we buy? sort of a year or two. In 2018, we bought a house in where we live now, like a principal place of residence, and this kind of changed our tack because that was a bit of a showstopper for lending for a couple of years on that one, because it was a high value house, and lending with high value properties, it's almost like a commercial loan in itself. Like it's low LVRs. It's tough. They punish you from a lending point of view.
So this is a property over $3 million then, I'm guessing.
Yeah. So it was, in Bellevue Hill in Sydney, and you look at the average house price there, it's pretty steep. So that just knocked us out for a while. And
did that mean? And again, I'm just based on what you've told me already, I'm guessing you might have had to rationalise some of the other portfolio to help fund that. Yeah.
So we actually sold that. My least favourite property always was that one in Maroubra. Remember that one second property I said that was a bit of a mistake? We sold that because it was just negative cash flow. Believe it or not, it had the worst tenants out of all of them. Like it was renting for about $700-800 a week. So it wasn't a cheap rental, but they were fussy and they were, I don't know, we just had problems with it all the time, and there was there was just an absolute headache. So it was good to get rid of that. We got out of that in the black too. That worked quite well, but it freed up a deposit, and it was reluctant. And this is one of those kind of redlining moments to buy that one in Bellevue Hill. It was a good price at the time, and we knew we had to go it as well. And I didn't know how restrictive the banks were going to be, and this was right in the middle of APRA at the time. Like, what was that?
Royal Commissions back in 2018.
Yeah. So they literally removed the people that approved the loan, and we had to get it all. I did a 4-month settlement on it, and that was probably the worst 4 months I ever had with property, because we're just the amount of things we had to move and shift around to come up with an extra deposit, because they offered a lower LVR on it. It was I thought I'd get an 80% loan, and it was either 70% or 65 from memory. I can't quite remember. But
ouch! And of course, the policy was almost changing on a daily basis. I remember it extremely well because we've got a broking business, and good grief, it was very difficult for any purchaser to have any confidence around. The pre-approval wasn't worth the paper it was written on, because they'd tell you one thing and then tomorrow the thing completely changed. So how did you deal with that? That would have been a pretty stressful time, I'd imagine, Scott.
Well, it was stressful because we were going to lose a deposit of circa $400,000 to $500,000 as well. And we knew the owners were going to take it. They were going to be ruthless if they could, because I do believe they worked out halfway through the process that they shouldn't. It was sort of, they sold it pre-auction and all that kind of stuff, so they didn't let it go to the market properly.
Right.
And it was probably at the low point in the cycle as well. So things were improving in the 4 months after that. So they were going to take the money. They wouldn't have given us grace to settle, and that added to the stress. But we ended up selling, I think it was 3 properties from memory. So I had to sell the one in Maroubra. I had to sell that Mayfield commercial property, which the only reason we sold that is because I went through my portfolio, quickly called up agents and worked out who would sell it quickest. And the agent said I could sell this in 7 days, and he did. He sold it for $100,000 more than we paid, which was about 25% more than what we paid for it, in 12 months.
Wow.
So we obviously bought well, and that again, because that was a 70% loan, so that freed up a couple of $100,000 there. And then selling the Anzac, the one in Maroubra was a one that freed up another couple of $100,000. And then we had this development site in Gold Coast, which I didn't mention before. That was one we were going to build some townhouses on it before we really dug into our strategy properly. We sold that at a loss to free up cash, but we got through it. It was just selling a bunch quickly, and we had sort of 32 properties at the time and went back to 29, but there was that big house instead, and we ended up making it by about 2 days. So in 4 months we made it by 2 days, and that was stressful, and I definitely would never recommend it to anyone.
Well, and I guess the other exercise there is that there would have been a very strong emotional pull to that property for both yourself and your partner, given that was the place you're going to live in. So that adds that
cloud
turns up the
judgment.
volume, quite significantly, because it's not about the numbers anymore. It's about what it means to your family's future, basically. So I can imagine that would have been quite challenging. And as you say, this is always the trade-off. If you're going to put a lot of money into the Taj Mahal for the place you live in, it comes at a cost, and that cost is hamstringing you effectively from investing elsewhere. So I'd imagine at that sort of a spend and with the rationalisation that then created, it was probably a while before you could dip back into the market, was it?
Yeah, and you're right. So we pretty much didn't do anything for a year or so, and then and this is sort of the next. It was almost a temporary strategy I started going with. I started investing in syndicates. So we were creating commercial syndicates because all our commercial properties were going perfectly at the time. Like, they were super high cash flow. They were creating equity. The tenants were fantastic and quiet to deal with. Like, it was like a 2-speed portfolio. We had all the houses and the unit blocks, which they kind of did their thing to get the equity, but they were sort of idling away. But then the commercial side was just a lot freer. There was a lot more. There's just more wealth getting created in that side, and you could see it because even just viewing the rental statements, that was just significantly larger. And so a way of continually investing was through syndicates. So what we were doing is creating unit trusts, finding things like shopping centres. So I bought into 2 shopping centres, one into ACT, one up into Queensland, and these were like very high yielding, sort of 8% type. One was a $6.5 million property, one was a $4.5 million property. So we just had about four people in each of them. So I was actually investing with clients at the time, and it was just like a family and friends, call it syndicate. So we just shared the profits, and the properties would lend on themselves. So that it was like a lease stock loan where the property would be strong enough to support itself. So you didn't need anyone guaranteeing the loan.
Right.
And that meant that, we could sort of just quickly invest without having to go through the hassles of revaluing the portfolio or refinancing. So it was sort of like an arm's length purchase, but we were part owners of very good quality assets. And
I'd love to just sort of on a very slight tangent there, just talk about syndicates for a minute, because again, syndicates quite often get badly spoken about, and the challenge with them, and I'd love you to expand on this a little bit, is getting very clear on what not the entry strategy, but the exit strategy becomes very clear, because as we all know, the more parties that are involved, the more dynamics, the more changes in needs that start to emerge over time, and then the wheels can fall off if one party tries to pull the trigger and others don't want to. So how have you, for the benefit of those listening to this and may have had an interest in syndicates in the past, can you sort of talk us through how you've managed through that to protect the interests of the parties once you're actually into those properties?
Yeah, so look, like you said, people have different goals and different circumstances in life. Like, I actually find that part not too difficult, because you can just set it all up very clearly with a good lawyer who's experienced in it. So you do handball a lot of that to the lawyer, but obviously you're all going to be agreeing to certain things. Like, you might say there's a minimum hold period of 5 or 7 years. Yeah. You might say you've got first right of refusals to buy the other parties out. There's got to be a lot of those terms and conditions in it, just so you can avoid someone just saying, I don't want to be part of it this year, or, I'm out, let's force the sale. Like, you don't want that, because you'll be forcing the sale at a bad time. And everyone needs to agree, and voting process, all that kind of stuff has to come into it. I found the hardest part was just getting everyone together at the exact right time to want to put the deposit to buy the property. It's like herding cats, because everyone might say, I'm going to put, let's say, $500,000 cash into this investment. Settlement's 3 months away, but imagine you're relying on 5 people to put $500,000 in to buy a large-ish asset, and then all of a sudden one of them's not there. That's the tricky bit. You really got to get everyone fully committed, and that's like, you got to do all the due diligence on the property. Like, it all has to stack up perfectly, and 1 out of the 5 might change their mind. So I found that the most difficult part of syndicates.
How did you overcome that? Did you end up having a trust account that you'll put your funds in before you then found a property, or how did you sort of? Because that is a big risk factor. If it takes a while to find the property, and then someone says, "Oh no, I've stuck the money. I've bought a holiday house. I'm out."
Yeah. So my strategy was we just over-raised by 5%. So we allowed a 5%, buffer for someone to, I can't put that amount in. I'm going to put 100 grand less in. Like, we're ready for that.
Smart.
But yeah, that was all we did, and it meant we missed it. Like, we still missed out on a couple, But yeah, I think in this market, like, everyone's like, there's such a fear of missing out. It depends on the market you're investing in. Like, back 2019-ish, it was not as gung-ho as it is right now. So people had reservations on certain things. So
yeah,
I'm sure doing a syndicate right now would be a bit easier than it was back then, because right now you can't keep people away from property.
You got to bat them off with a stick. Exactly right. Yeah. No, it's spot on. No, that's great. So obviously then leveraging that additional, using other people's money effectively without the banks, and then avoiding the guarantors under that unit trust structure. Would have enabled you to leverage into significant property. So there's those couple that you spoke about. There's good 11 mil there that you spoke about in those. Did you continue beyond those, or where's the portfolio currently sitting at?
Yeah, so currently, so my strategy now is I'm slowly de-leveraging out of some of my cheapest properties, and I've currently got it's a property right circa 10 million under contract. So I'm going large assets, but less of them. So if you ask me this in probably a year's time, there'll be a whole lot different. Basically, it's decluttering, going for higher value, higher quality assets, but keeping the best of them. So this is a good market, and I say this to clients: if you've got dud properties in your portfolio, it's actually not a bad time to potentially get rid of them, because you're going to actually probably have a buyer for them. If the market's weak, it's sometimes impossible to move a property that isn't any good.
Yeah.
So I'm using this hot market very slowly. Like, I'm probably only going to sell 1 or 2, each year. But it's just about sort of getting rid of the ones that have probably done their thing, and just getting into better quality assets, and that's probably what I'll be doing for the next few years, foreseeable future.
So are you? And I'm guessing here that you've got the size of the nest egg effectively is where you need it. The important thing for you now, I guess, is so it's not so focused on growth anymore. It's probably more about debt reduction and freeing up the cash flow. Is that the transition that you're making? Yeah.
So it's just increasing in the income, increasing the length of leases, and just having those less touch point tenants. So some sort of larger warehouses or branded type tenants. They're the ones that I think I've got a lot of clients in similar positions to myself, and it just depends on what stage of the journey you're at. Like, you need that foundation property. Like, you don't just jump into a big commercial property unless you've got a lot behind you. And it's just about sort of buying quality over quantity for me. And when I was younger, it was more about quantity, and that was probably something I wouldn't call it a mistake, but I could have been more efficient, that's for sure. But it was more just buying as soon as I could, and just not really looking at quality as much. So that's how I've changed from 10 years ago, I guess, to now.
So let's paint a picture of your absolute ideal lifestyle for yourself and your partner, and I'm assuming there's probably some little O'Neills running around as well. What does that look like? Yeah. What does that look like, and what does that lifestyle cost, and where are you at in relation to your portfolio funding that without you needing to have to work to service the debt?
Yeah, look, currently, without these new acquisitions, we're sitting sort of just under $500,000 passive income from them. So we are very comfortable. Like, and that's probably people that work with us in our business. They really notice we're very casual with how we sort of buy properties. Like, it's not, we don't need you to buy them. It's really just we're just sort of helping buy things because we like being involved in it, and that's because, I guess, I remember when COVID first hit, I thought the business would wrap up. Like, I'm selling or buying commercial properties in a pandemic. Like, it couldn't get worse than that. But like, we were comfortable because there was a portfolio behind it. Like, that's about the biggest difference it makes. It just makes you more comfortable that you've got something behind you. If everything else goes to crap, the nest egg will be the safety net. And that's why it's not about just a dollar amount anymore. It's not about, it's more just decluttering and trying to get a bit more time back. And my wife does cop a lot of emails and calls from this portfolio. Like, she manages it, Mina, and she's very good at it. But like, if it's just time consuming, and it's not fun dealing with the same little problems all the time. Like, even a couple of months ago, like in one weekend, we had a $16,000 cost for a replacement of a balcony because it rotted through. There was some termite issues in another one. There was a fight and cops came into another property. So these little houses that were bought over the years are having all these problems, and they all kind of add up to, is really doing you a favor. And that's probably where our head's at. It's not about sort of how much money is this property making. It's like, how do we just get rid of the painful ones and just redeploy it into quality stuff that you don't have to hear from it. And then, because we like pre-COVID, we were going overseas at least 3 months every year as well. So managing things overseas in a different time zone is also another element of problems. And we actually found, because we were slow responding to some things, we're letting vacancies drag out. Like, this is, and like it, if you really run the numbers, like the portfolio was sort of wasn't well managed as well. So like, just having, that's sort of where our head's at to fix it. So our ideal portfolio is just probably reduce the percentage of residential, increase the percentage of commercial again, and just higher value, bigger tenants.
Now, I think you've mentioned a really important point there, because what's your other half's name? Mina, did you say?
Yeah, Mina.
So Mina would have a full-time job managing that portfolio. It would, in fact, it'd be more. She's basically a property manager extraordinaire if she's managing that whole exercise. And I know that because we've obviously trod on very similar paths. We actually had a property management business because we were so dissatisfied with the quality of property managers that we were experiencing, and that's a very grunty exercise, there's no question about it. Is part of the strategy, and by reducing the number and higher quality and getting into commercial where there's less of those sort of tenant headaches attached to it, that's obviously going to free up time. But is Mina keen to continue to manage it that hands-on, or is it at some stage you're going to be looking at getting independent professionals to be managing on your behalf, so you've actually got more time to put into the things that are important to you both?
Yeah, and that's a potential. And I guess one of the good things with some of the commercials we've got, you actually don't even need managers, like, because they're direct debit setups from an accounts payable department who's the tenant. So it's a whole different ball game. Like, if you're dealing with the right businesses, so we're looking, one of the properties we're looking to buy is a KFC. Like, is KFC not going to pay you? Probably not. So do you need a manager for that? I don't know. Probably not. Like, they're the types of things you can sort of, I guess, put zero time into, like, compared to managing 10 properties that would equate to half the rent of that one tenant. It's chalk and cheese. Like, you can actually own a lot of this commercial stuff and very little work for it. And you can still have a rental manager in between you as well. But if we kept going down the residential route, we would 100% probably have to look at a bookkeeper full-time just on the portfolio. And that's a cost, and that would hurt your cash flow for the properties and make that business less viable. So look, it's it's a different direction that through investing in both residential and commercial, for me, it's an absolute no-brainer. Like, it's once you know like which properties, once you're comfortable with the commercial property world, it's quite liberating because you know what types of properties are going to do well in most economies, and there are recession-proof tenants out there, and that's the ones you can look for.
Yeah, spot on. Well, that's a great segue into that subject, because what I'd love to do now, very quickly, if we can, is just dispel some of the myths that people and the media have helped to promulgate, by the way, around commercial property, particularly in the post-COVID world where, you know, the commercial space has copped an absolute flogging in the press. Talk to us about one of the main myths that's attached to it is that, well, you know, great yields, yes, but we're not going to get the capital growth. What do you say to punters who come up with that theory?
Yeah, so it's a myth, and I think it's spread between people who are, I think it's spread by residential real estate agents, maybe. I don't even know where this whole myth came from. Because if you go look at any commercial property, like, you know, let's go look at Western Sydney. Go look at you go on RP Data and check out what, you know, your local warehouse sold for in 2000, and look at it now. Like, they've tripled in value, and some areas have tripled even in the last sort of 15 years as well. It's crazy growth. Like, you don't get growth in only residential, and commercial stays at the same dollar amount. Like, imagine you've got 1,000 square meters of industrial space next to a suburb, and you look at the value of the residential properties. One does just not stay at the same value while the other goes up. Like, there's a flow over. Commercial is driven by yields as well. So, you know, as the rents grow, so does your capital value. There's a lot of the properties that you can buy are gaining in popularity now in terms of like the types of investors buying into it. So there's actually more demand flowing into commercial than there ever has been. There's more, you know, I quote mums and dads, you know, the inexperienced investors now going into commercial because the banks are allowing them to. They're seeing the yields in residential are at record lows, so it doesn't make much sense to keep investing in residential. Like, I moved out of residential for a reason. I hit walls. I think there's people hitting walls a lot quicker now because of lending, and the yields are lower. So, you know, you got to look at alternatives. And commercials, this beacon of light of massive cash flow still out there, even in 2021. Like, the numbers work. Like, we're averaging about a 6.5% net yield for our clients, and like they're good yields when you're getting interest rates into the low 2%. So that the gap between your interest rate and the yield on offer is you know, nearly 4% in some cases. So you're making money just on debt, and on top of that, you still get rental growth. And we're seeing double-digit growth rates right now. That will not last forever. We're going through a boom in most industries at the moment, it seems, but commercial is super undersupplied, and there's a lot of buyers, and that's causing growth.
Well, let's break that down a bit, because I think the big issue here is that a lot of people put the commercial hat on office buildings. You talk commercial and their head goes straight to CBD office buildings. And yes, they've been clobbered and will continue to be clobbered. And our superannuation, those who've got institutional super, that'll be clobbered because there's a fair slanting beyond equities into commercial CBD office buildings as part of their portfolios. But the world of commercial runs a lot further than CBD office buildings. So talk us through where you think the opportunities are in the commercial space. And we're talking here essentially about retail mum and dad investors who might be going, well, let's have a look at this. Are you happy to break down where you think the opportunities are, both in terms of the type of property, but even let's go around the grounds quickly based on your national view of what they should be looking at and where? So
I'll be super direct. I'll tell you like where we're investing, Rethink Investing, my company. So there is The reason I'm comfortable saying this is we buy most of our properties off market. So it's not like we're shooting ourselves in the foot, telling you where we're investing. But yeah, we are buying probably about 75% off market. So where we're buying a lot of stuff is Brisbane industrial. Industrial is super undersupplied. It's hitting record low vacancy rates. COVID has pushed more retail businesses into industrial space. That is causing rapid growth. Leasing periods of now, it only takes, I'm generalising, 2 to 3 months to find a tenant. There's some cases where, there was a shed in an area of Brisbane that was vacant. It was 1,700 square metres. It went vacant in COVID because the business actually grew, but it was only vacant for 6 days before another tenant came in. So long vacancies are very possible and very real and will happen in commercial, but they don't always happen. If you buy a good quality asset in a good area, the vacancy will be quite shortened. And remember, you're dealing with longer leases, so hopefully you're not looking for a tenant. Hopefully it's only every 5th year or every 10th year. Like it's not a regular thing. It's not annually.
Yeah,
that's the big difference. So
when
you get a vacancy, expect it to be a bit longer because there's, I guess, a more specialist nature to the business. But we're seeing opportunity there. Yields are actually almost getting a little bit tighter now. So opportunities also exist in Adelaide and Perth. I think you just got to be slightly more careful in Perth because it's more up and down that market. But I really like medical assets in all the capital cities. So anything from pharmacies to GPs to dentists to even just specialists, any type of specialists, especially when they got an expensive fit out. Like I'll always bring up the dentist model. The fit out for a dentist can be $500,000 for a relatively small place. So would they move next door because the rent's 10% cheaper? No chance. No, they're in for good.
Golden handcuffs, basically, as a result of that. And they put their heart and soul, and they're not going to walk away from that in a big hurry.
Yeah, exactly. And I like Canberra as well, like big master plan community. There's some there's places where retail works very well in Canberra because there's just simply not acres of supply like there can be in other parts of the world. Like you wouldn't go buy a high-rise office space in the Gold Coast. There's just too much supply of that. But look, office space is the one that catches the media's attention because it's easy to relate for people who don't know this space. So that's why your headlines drive towards that. Yeah. The other one is the Filet signs in front of a retail shop. A poor quality retail shop will go vacant regularly. And this is the difference. If it's in a really good area, maybe a corner block, in a affluent area, or it doesn't have to be affluent. It might be just in a regional town, but it's in the center of town, and you've got the real estate agent who wants to rent that out forever. Like there's very good retail out there. Retail is not all bad. There's just, I wouldn't be going to buy high-end fashion right now, like stuff like that. There's a weakness, and just think about whatever you can sell online cheaper than in a shop. That's where you just got to think, maybe is that business model going to be there forever? Like fuel stations is another one. Is that going to be in here in 15 years? Maybe not. I don't know. How quickly are we going to adapt to electricity? These are the things you've got to think about when you invest in commercial.
Yep. Smart. Well, it's no different from resi. You're buying a property with a view of what's this going to look like in 10 years' time, not what does it look like today.
Yeah.
So that's brilliant. So you've covered some both locations and the styles of property there. It painting the picture out as, because everyone's an expert when it comes to property, Scott, as you know, and there's 1,000 different opinions around where we're at, where we're heading, and is the current boom going to last, and if not, what's likely to roll out? What's your read of what's likely to happen in property generally and commercial in particular over the next couple of years and beyond?
So on the coalface, because we're actively negotiating on properties for clients every day, and I'm seeing competition still rising. So the price is actually building momentum still, particularly residential. We're not as active in that space, but you can still see record price after record price. So there's a lot of there's tank and the gas still there. Sorry, the gas and the tank rather in that. So how long will it go for? Like, I worry a little bit more for residential than I do with commercial, because I'm quite conservative. I just think it seems top heavy. Like, you look at people's incomes, you look at the prices things are going for. There's a lot of aggression when people are buying. Like, could it cop with a 1% interest rate hike? Like, no, there'd be a lot of people in pain, and that's I'm sure that. Like, and this is the thing. I'm never one that'll think it'll drop 40%, because what all the doomsday merchants don't realise is there's hundreds of triggers the government will pull out to stop those crashes happening, because it's for the greater good. You don't want the market to crash. They might think that some people who can now afford the market will be good for it, but the reality is it will be worse for everyone if it crashes. So there will be stimulus measures, forever. That's just my opinion. I
totally agree.
We've seen it in COVID. Look what they did.
And what the RBA governor said, we will do what it takes. Yeah. So when you hear those sort of that commentary, and given that over 55% of the wealth of the average Australian family is in the home, homes means votes. So anything that's going to drop in value is going to put a government into opposition. So it ain't going to happen. So
exactly,
100% agree with you in that regard. But I also see where it is getting top heavy. There are going to be some thresholds that people reach particularly in certain locations. Where good locations will always perform well and will continue to. But not the tide won't float all ships moving forward. What about on the commercial side then? What's your predictions on where that's likely to go in the short to medium term?
Look, I actually think there's a lot more to go for commercial, and there's two main reasons. One, the yields are still so much more attractive. It's a good way just to park money up and make money. Even without the growth, you're going to make very good yields, like 6-7%. Like, these are, if you buy $1 million property, you've got a $30,000 mortgage on that. If you've got a 7% yield on that, that means you're clearing $70,000 net income minus your mortgage, which was 30. That leaves you 40 grand in your pocket just for buying a property. You'd need a 300K deposit to buy that. So you're making a very good return on your money just through cash flow alone. So as an investment class, the numbers stack, and that's why I think there is room to move. The second reason is because residential, which is now worth $8 trillion in value, I think they said the other day, is at record levels. There's a lot of people with equity that have the ability to use that. Are they going to go and buy more residential and keep feeding the beast? I don't think it makes sense, because there's no margin in it for developers right now. There's no margin in it for second-time investors or third-time or fourth-time investors. They need alternative investments, and a higher cash flow model is more attractive again. So I think it'll push a lot more investors that were never going to consider this as a commercial into it, because they got the means to, and it stacks up. Like, that's why my job's very easy. I don't need to sell these properties. I just show the numbers and it does the job.
Itself. Yeah, exactly.
You don't have to talk about airy-fairy things about, look, they're going to build a station here in 5 years' time, or, there's a bloody gentrification comment. Like, you don't need any of that. The numbers stack in today's terms, and that's why I think it'll grow on itself.
Yeah, and particularly for those investors who are at the cash flow end of their journey, that's where the key is. And there's a lot of people in that just under the baby boomers who, how can I now convert my nest egg into a tax-effective income stream to fund my ongoing lifestyle? Well, given the sorts of yields you're talking about, plus the capital growth is almost a bonus in that regard for those that are looking for that. They based on the work you're doing, that you're able to identify properties that right from the get-go, they're putting a substantial income return in their pocket, and a yield level they're not likely to get anywhere else either in the next decade, given that we're likely to be in a very low interest rate environment.
Yeah.
Interesting. No, that's brilliant, mate. Well, we've only just touched and scratched the surface, and really enjoyed our conversation, and I've loved the way you've sort of taken us through the evolution of your thinking around that. I'm going to get you back, and we'll drill down deeper into some of these subjects, because I think there's a lot of learnings that we can take away, and you've been very generous in sharing that. But to sort of bring our discussion today close to a close, I'd love to jump into what I call the ambush lightning round, mate, where it's just 5 quick questions that the listeners always love to enjoy your words of wisdom on. So first of those, mate, is what's your favourite quote and why?
Oh, good question. It's probably that, typical investor picking a Warren Buffett one, but that quote where he says, when the tide goes out, who's swimming naked. And I like that because in good times, everyone thinks they're a hero with investing. It's almost like the Bitcoin bubble. Everyone's buying a Lamborghini and all that kind of stuff. And have they really built fundamental wealth? Have they really planned for the rainy days? And that quote just captures that. When the tide goes out, because you need to understand what happened in previous busts, and that's something I've always studied. Like, you've got to know what, how other crashes have occurred and how people got out of it. And if you don't do that and you're trying to scale an investment and you think it's going to be like it is today forever, then you can get hurt. And you don't want that. I don't want that for anyone. You just got to keep your buffers and invest safely and sustainably.
Yeah, spot on. Yeah, great advice there. On the reading front, what's the top book that you'd recommend listeners have a read of, Scott?
It's almost on that topic. Like, this is how terrible it's just busy lately, but I haven't read a book for about 2 years. But I'd probably recommend that. I think it's called The Secret Life of Real Estate and Banking. It's Philip Anderson is the author. It literally goes through the last 300 years of boom and bust in the US, like from when the cotton fields and the train line booms and all that have caused catastrophe in the economy. And it really just paints a picture of how interest rates and, the over-exuberance of investors have kind of, this has always happened. And there's actually quite an accurate 18-year cycle that it seems to follow, mysteriously. And if you read that book, it'll tell you when the next potential crash could be. And that's a good one. And I'll give a shameless self plug for our own book. We've got a Rethink Property Investing. It's literally just a book about almost what we're talking about, but in a lot more detail. We talk about all the different commercial asset classes, the different strategies to play, what types of investments are safer than others, how to do all your calculations and that. And, if you are interested in looking over the fence into commercial, that's a book I wish I had when I was starting out. It would have sped up my learnings, because in Australia, there was quite literally 0 books on commercial real estate. And there's hundreds in residential. So, I guess there's 2 books there.
Yeah, and well slotted in the plug there. I was going to mention at the end, mate, but you've beaten me to the punch, so that's perfect. Mate, most Australians believe they pay too much tax. So what's the top legal thing that you've done to minimise the tax that you pay?
Look, buying properties in family unit trusts have worked quite well. Commercial is a way of reducing tax as well, because you can claim the full amount on the building and the fit outs as well. So it's basically more tax effective because you get larger depreciation benefits. So that's been a good key. That's basically it. It's sort of hard to do much else. Like they'll get you at every corner, but I found commercial was a way of at least enjoying a larger income, but not having to pay exactly half of it back.
Yeah, exactly right, which is a hidden benefit there in terms of that ongoing affordability piece as well. Final question in this then. Well, no, not quite the final question. What's both the worst and the best piece of investment advice that you've ever received to date, Scott?
Probably the worst is only buy where you live. That's just that was almost like the old school investment way, because that area better than you do other areas. It was easier to invest in your local area only. And that in a way, like, it wasn't a terrible mistake, but it meant we slowed ourselves down to a degree, and we had to offload an asset that we probably wouldn't have otherwise bought. And it was a substantial asset for us at the time as well. So
Yeah.
if only we, like, because I'm a borderless investor, like I'd invest internationally if the opportunities were there. But luckily for us, Australia represents such good value and opportunity. We don't need to look abroad. But I think you've got to treat things like you would in the share market. You don't only invest in a bank because you know the head office is down the corner. Like, you invest because it's good value, and
Totally.
you've got to understand it.
I agree with you. We are actually internationally borderless as well. The first thing that happened when the GFC hit, we jumped on a plane and went to the States for 3 months and picked up properties at just unbelievable prices. And all they needed to do was return to their long-term average, and we tripled our equity position. So I totally agree with you, mate. Just looking beyond the backyard at what else is out there, not only in terms of location and property, but as you say, looking beyond resi into commercial and other avenues. It's just got to get your knowledge up to where it needs to be. Have a read of your book, Rethink Property Investing, to get your head around it, and then surround yourself with the right professionals that can help you make it happen. Now, I love that. What's the best piece of investment advice you've ever received?
Probably just treat every investment like you would if you were running a business. And that's probably so whenever you buy a property, think about it as a business. If you were buying a business, would you want to buy one that's negative cash flow just to claim tax back? Or are you looking only for the depreciation benefit, or are you only looking for the business to grow in value and not worry about anything else? Like, they're false economies. Like, if you look at it to produce proper income and it's doing very well, it's profitable, and treat it just like you would growing a business, I find you'll do better overall as an investor. You'll be able to scale larger. You're producing an income that will help you lend easier and scale, and basically there's more money coming in, and but you don't neglect the other angles too. So I guess you just got to look like a portfolio as a business, and that, I don't know who told me that, but that's exactly what a lot of people don't do. And
Spot on. It's almost a part-time hobby that they occasionally get around to, and then they wonder why it doesn't perform. So that's brilliant advice. Well, in conjunction with that, then, what's a personal habit that you've developed that you believe has contributed most to your investment success to date, Scott?
Look, it's probably just persistence and the fact I enjoy it, which helps the persistent side of things. So if you don't enjoy investing, and I've met many people who've tried investing that they couldn't cope when there was a bad news story, like a tenant left and things like that. If you're not a problem solver and you don't enjoy this, it's definitely not for you, and because you won't have the stamina to keep doing it for decades. But if you do, latch onto that and own it, and just you'll go further with it.
Yeah, no, beautifully said, mate. To wrap it all up, the big final question that gives you a chance to sort of bring the keys together. If I gave you a microphone that spoke to every single one of the 7.8 odd billion people that are currently alive in the world, and I gave you 60 seconds to talk, what would you say?
Oh, good question. No, I would just do what you want to. You got to enjoy what you do. Think long term. If you don't have a long term mindset with business, you're not going to be ethical, and if you are ethical, business will probably be better for you anyway, because you need it to be better, because it will give you the freedom. And I think that's how I've lived my life as well. And think long term, but it's not all about business either. So, which I need to listen to my own advice a bit too, because you get trapped into the business, and next minute you're working 15-hour days, but it's enjoyable. And if I didn't enjoy it, I wouldn't even get past the 8th hour. So I hear exactly what you're saying on that front, mate. Been very generous in unpacking the nitty-gritty details of your own journey. Really appreciate you doing that, because there'll be a lot that the listeners take away from the learnings there. And you really have opened our eyes to the opportunity that commercial brings into the equation.
So there's just another bow in the armoury there for investors to start considering seriously, particularly in the current situation that we're likely to be in the short to medium term. So really appreciate you doing that. For those that you've really pricked up their ears and they're keen to hear more and potentially do more with you, what's the best way for them to get in touch?
Probably two ways. Just Google Rethink Investing, or rethinkinvesting.com.au. There's a website there with all the contact details, and the other option is if you want to slowly get into this, and we do like people. The more they know, the better it is. If you are looking to get into this space, even just start by purchasing the book, because you'll learn a hell of a lot on every. You'll literally be up to speed with all of this, and then you can decide if you would like to reach out from there.
Yeah, brilliant idea. What we might do, Scott, and we'll talk about this afterwards, is set a challenge for the listeners and get them to send something into us, and then you and I can decide on the best submission and potentially perhaps give away a copy or two of your book if you're happy to do so. Too easy. No problem. Fantastic, mate. Look, really enjoyed the chat. It's been really good to connect at long last. Look forward to getting you back on the show sometime soon. But in the meantime, look after yourself. No, you too. Thanks, mate. Thanks, mate.
Get a summary of all this investment gold in the show notes. Just email me on hello@khgroup.com.au. That's hello@khgroup.com.au. Or check us out at www.bushymartin.com.au/Get Invested. I look forward to joining you next week for another episode of the Get Invested podcast. So thanks for listening, and as always, dream as if you'll live forever and live as if you'll die